right now. Okay, so a lot of risks in the market that we're seeing, or narratives for the most part, we have a lot of analysts coming out saying, "Hey, this is a correction. This is a pullback where the market is overbought. All the risks are starting to hit the table, and really, it's all about inflation. Although, we hear all these stories. Everything comes down to the inflation risks. Now, I have oil highlighted here because it is the biggest input to inflation, but the main issue is when it comes down to it is we're going to see the inflation rise right now. So looking at expectations, right? The market is expecting, right? The consensus is that inflation comes in at 3.3%. Although the previous, or well, I guess you can see here, the previous inflation headline CPI was at 3, we're due to tick up at 3.3. Okay, now that sounds terrible. It sounds like, okay, the trend is going back up, right? If we turn this into a trend, we look at the trend, we've dipped pretty fast to the downside, right? Inflation has fallen like a rock. It actually has fallen like a rock. I believe this is the most consecutive months in a row that inflation has fallen. I don't think we've even had an up month yet. This might be it though. This might be the up month. And it doesn't mean inflation is now going to trend up from here. It just means that things are going to slow down. And that is primarily because of August, right? Here in red, I have highlighted the price of oil. And energy prices are the real culprit here to bring that inflation report higher. This is about the only thing. So looking back in July, because the report reflects on July that we're going to see in a couple days, oil is up 17%. So that's going to push headline inflation up. Now, look a little ahead. Let's look ahead a little bit, right? Yes, it's going to go up. But the following month, if we go to August, well, this will happen in September. Right now, it's sideways. So right now, yes, we can forward look and say, okay, well, this month might be higher than expected, but the following month, measuring today, is flat. It hasn't really moved. We're at $82, $83. Now, if we get above that, oh my goodness, here comes more risks. Rates probably go a little higher. The Fed might actually be tempted to keep hiking 25 basis points. But right now, right, we might have this off month. That sounds very negative. That sounds very, oh my God. Okay, sell everything because inflation is back, right? We are reaccelerating inflation. But it's really just oil making a big upside move. When we saw this, we saw this previously when oil bounced here, and inflation really just paused. They didn't make a big upside move. Now, the positive thing here is let's assume we don't get above 83.50, which is the zone here. All right. Let's say we don't get above it. Well, the next report's going to be in the twos, easily in the twos. Okay. So the market is expecting this month for us to dip to, or actually move up to 3.3. But the following month, if oil continues to get stuck at this level, which there's a lot of reasons that it does, then we should see the August inflation just pretty much in the twos, another sharp drop. So the market is anticipating that, okay, there's going to be some selling. We're a little overdone here to the upside, right? Tech, we need rotation. We need market breadth. But that is one risk in there. And there's other credit risk. There's other stuff. It's really the supply. It's really rates, right? The bond market is what's actually signaling this risk. I don't even think it's inflation. Now you hear that, the Fed, we're going to go over the Fed speak this morning. We had a lot of Fed speak this morning, but for the most part, core inflation is what they've also been targeting. We know this will come down, but if we go to core inflation year over year, right? That is, I think they're overshooting it. The expectation is at 4.8. And the previous print, we had the largest drop, right? This takes out energy and food. If we remove energy and food, then the oil price surging doesn't matter. The oil price surging isn't an input to this scenario. And I think one of the Fed members who spoke today, I can't remember exactly who it is. We're going to go over that. They're pretty optimistic that the Fed can pause here, that the Fed can start cutting next year if we keep getting this deceleration. Now, that's minus oil prices. We're talking about core, right? Core is in restrictive territory because the Fed funds is already at 5.5%. We're sitting at 4.8%. So let's keep that in mind. I might pause there. I'm getting a phone call from my brother. I might have to answer that in a second. Actually, I'll call him back. But anyways, hopefully it's not the babies getting, the baby's coming out right now. If it is, I'm gonna have to leave the stream. But yeah, we're waiting for my brother to have his baby. All right, so again, like I said, that core inflation rate is gonna fall. Okay, I'm a little more optimistic. I'm gonna bet on this. It says that we mute at 4.8%. We should come out at 4.8%. My guess is that we drop. Why? Because earlier in the week we got used car prices, which is one of the large components that is holding up CPI, and they fell further on the year-over-year basis. So I think the market is really just preparing. Okay, this is oil. Okay, we know oil has surged up. That's why the inflation rate's up, but it is now, consolidating 83.50. But my guess is if we take a step back here, okay, the market is front running this inflation report. Nothing has changed. The economy is still strong. Okay, the economy is still strong. This was the target we marked earlier, which was the 4,400 target. I don't think we're still not there yet. I think we're gonna touch it. What do we get there? Oh, you got it, Football Legends. Hey, appreciate it. Thanks, man. Sorry, I'm still going here. I appreciate the sub. Shout out to you, man. Shout out to you. We're gonna talk about this market. We're gonna get through kind of what we're looking at here. And again, I'm off in this week. I'm taking a small, not really vacation, but things are gonna be a little different this week. Maybe it'll be good. And I'm actually planning on starting these a little later, just for you guys. The time might be a little better to get most of the news in. I really see nothing. There's no news that has changed. Nothing has really changed. It's just you see price action going lower and oh my God, everything's falling apart. The market is just pulling back into technical support. It is really just trying to price in the downside of CPI. I think that's what we're looking at. The downside of CPI, it is pricing in that downside of CPI, which is that CPI headline will not fall, right? It's not going to fall this month because oil went up. So we are seeing SPY come right back. There's nothing has broke, right? We're pulling right back into support. It looks like this trend broke, but this was a sharp trend. Okay, this is a sharp trend line. It is broken, so we got to take that off. That just means markets are rolling over. But the strong support here is at 4,400. Okay, now if we run over take a look at the Qs. The Qs are still on trend. Okay, 8 p.m. baby. Oh, nice. So Thursday. So we will. Looks like I got a message. The baby's coming on Thursday. She's going to be induced tomorrow. So we'll see how the schedule goes. And hey, late night talks with family that's why I'm so tired today. A lot of late night talks that I just haven't had. So it was good. It was a good time. But yeah, I just want to reiterate here that the inflation, inflation there's two inflation targets here. It's CPI core and it's headline. Core is literally just minus energy, minus food. And that's the part that's going to come in positive. I'm pretty sure it will. So we're watching the market just pull into supports here, right? If we go to the Dow hasn't even pulled back yet. The Dow's still strong. Market breadth still remains. Citi recommend a long December 24 structure before CPI. Okay, Citigroup. So you got a lot of changes in the banks. We go to IWM, small caps. They're also pulling back a little bit. Nothing too negative. Equal weight S&P just pulling back. So I don't see anything too much to be worried about. If anything, that target at 3.3% might even be an overshoot. That might even be an overshoot. Maybe it doesn't factor in that much. It is possible, but maybe it doesn't. Now, what we really got to focus on here is if inflation does come out, right? This is what we're expecting. If it does come out in the twos, the market will rip. It's going to rip if it comes in at the twos. Is that the highest probability? No, I give it probably like a 10% probability. We come in at 2.9, probably a 50% probability we come in at 3.3%, which would be what the consensus is, what the market is expecting, and maybe like a 30% chance that it overshoots to 3.5. That would be negative. We get a big sell off because expectations are higher than expected. But the core should fall. Okay, so we're going to keep our eye on core inflation year over year. Shelter's coming down. Manufacturing is still in negative territory, so there's a lot of pressures that suggest we're going lower. So the real risk here that we are witnessing is really the dollar. What do we always say? Take a look at the dollar. The dollar is bouncing. It didn't sell off completely, but there's the dollar signaling in the last, I would say the last 20 days, risk off. It's signaling risk off. We're seeing risk off behavior from the dollar, and that's because we're set to see oil prices push CPI up, And hey, you're yielding a lot on cash. And I think that's the real reason for this is if cash is yielding you, if the Fed keeps hiking rates, right, you want to stay safe. Well, the dollar is giving you that safety net. Cash is giving you a safety net. It's yielding, it's yielding the highest it's yielded for a long time. So the dollar going higher is a representation of the flight to safety, the flight to a risk-free. The dollar is pretty risk-free at this point. It doesn't really move much on a percentage basis. It's not like the bond market. If inflation comes back, as a lot of people expect, the dollar will move higher. So not only will you be yielding 4.5% on your dollar, but you also, the dollar actually increases in value. So this is the big risk to the stock market, right? To risk assets. It's the dollar moving higher. That's what stocks are competing against, is cash. Stocks are competing against cash, the yield on cash. So we're keeping track of this, of this trend, and we want to see if it goes up. Now, the positive is so far, look at 2-year yields are rolling over. So this kind of signals that rates are not climbing, right? That a lot of liquidity is not going to be sucked out of the bond market. So far, it looks like liquidity is coming back in. Whenever you see the 2-year yield fall, that means bonds are being, bought. The 2-year yield is being bought, right? Probably because they're yielding 4.5%, 5% for 2 years. Okay, so that's positive. 5 years falling, 10 years falling. So financial conditions, maybe they peaked. Hopefully, maybe they peaked here at 3. For the 30-year, maybe they peaked. This is the big risk too, is that 30-year mortgage rates start to surge higher than expected, but maybe they did peak. We don't know. We are keeping track of this as the numbers come out. And what we're going to do is go over some of what the Fed said to further track, okay, what is the bond market reacting to? I think they're reacting to the Fed speak that we saw earlier. There was no economic data. Look, it's a dry week. Monday, Tuesday, it's really dry. There's nothing till Thursday. There's nothing significant in the data until Thursday, which is inflation. And we have a couple things to look at, core and headline. That's it, right? The VIX is starting to pick up. So we are seeing a risk off in the VIX. So we are seeing volatility in the VIX start to pick up, which kind of signals that, okay, people are purchasing. They're more interested in purchasing insurance against the S&P, against stocks, because stocks are pretty elevated. So that makes sense, right? I wouldn't be too worried unless we get above 20 again. If we get above that previous zone, then this is where it's like, okay, what is the real risk coming in? It's probably the dollar going higher. It's probably the dollar definitely going much higher than where it is currently. So I'd be worried about the VIX getting above 20. It could spike into CPI. I wouldn't, especially with, the expectation at 3.3, we could see the VIX spike into 3.3%, into that print at 3.3%, and then come off. And then definitely come off the table. So stock earnings have still been positive. They are bottoming out. Maybe the market ran up on that, but we could be bottoming out there. All right. So what about credit risk? Are we seeing a lot of credit risk? Not really. We're not really seeing a whole lot of credit risk. Nothing is collapsing. It's come down a little bit. Junk bonds, right? High yielding bonds, nothing too negative. So for the most part, like I said, it's really just comes down to, is the market gonna, take the expectation of the headline inflation positive? Is it gonna find support off that headline inflation print? And if it prints below expectations, how far does the market bid up? And if it prints above, how far does it fall, right? And the easiest way to gauge that is just looking at the dollar. The dollar is gonna give you your sentiment reading when it comes to those, to those scenarios. The dollar is gonna give you that reading, right? So yeah, we're on pause right now. Not too much going on. I think the only index that's moving up today is everything's pretty much selling off is healthcare. I believe it is healthcare. Maybe it rolled over a little bit, but maybe it is healthcare. Bitcoin's actually holding up pretty solid lately. You had a little bit of liquidity coming here while stocks are down. So this is interesting. You're seeing some divergence from the stock market and crypto. Well, not really crypto. It's mostly Bitcoin. I think Ethereum caught a little bit. So you get a little bit of a divergence there. And who knows, there's a lot of talk about regulation and Bitcoin ETF coming in. And, Kathy Wood talked about it yesterday. And hey, the sooner that comes, we could see a rotation into crypto. We could see a large rotation into crypto. So I'm definitely keeping my eyes on that. Okay. Now let's move over to the actual charts here. Take a look at how the S&P is moving intraday. How is Shelter doing? Yeah, Shelter's coming down, Asan. Shelter's coming, which is why I think the biggest news that we're going to see, the biggest positive news we're going to see is core inflation is actually going to be falling while headline for the first time goes up. So recently what we've been seeing in the last 6 months, 7 months is headline inflation falling fast and core struggling. But we're going to see a reversal. I believe we're going to see a reversal of that where core starts to fall and fast, maybe not faster, but core is definitely going to be going to the downside. It's going to make a move lower. Well, headline maybe stay sticky at least this month. Okay. Now, does headline drop the next month? Well, that's going to depend on oil prices as usual, right? Commodities in general. So yeah. Now intraday, let's take a look at the SPY. How bad is this actual price action? Is it terrible? Right? Are we filling gaps and just getting wrecked to the downside? Is there any buyer stepping in? I think you have some buyers stepping in here. There's a couple buyers. IWM is positive on the day. I really think the market is just coming into support, trying to find a support area, and it's probably going to sell that off into the inflation print because the market sometimes sells off before the news or bids up before the news. I always think it's a little better if we sell off into the CPI report, and then we're going to get a little closer, because if the CPI report isn't as bad as feared, or if it's a little better, you're definitely going to get these fund managers or these people in cash that have been off sides come back in and say, okay, let's take a bite of this. Let's take a bite of this price action because it wasn't as bad as we thought. And, S&P's down, so the valuation is better than it would be if it was bidding up. Earnings are starting to bottom out. We know GDP forecasts are going up. So GDP forecast being, upgraded consistently over the past month tells you that S&P earnings should be up also at the end of the year. We should see S&P earnings moving up at that same time. So here's the price action right now. SPY moving up. I still think, again, we probably come back to 444, right? Or 4,400 before we actually get the inflation report. I think that's the major level to come into on the SPYs. Qs are actually a little weaker at this point, but they've ran up a lot. So Qs are a little weaker than the SPY. Okay. So keep your eye on that. Also, what is the Fed saying? What is the Fed saying? Let me see if I can find the Fed speak. There's a couple trackings on the Fed's. Let's see, where's the Fed speak at? I think it's right here. All right. So here, who was it that spoke this morning? I'm going to go over some of what the Fed is saying, interpret it. Like I said, there's not much news coming in. You hear all the people pushing all this micro news. You just watch price action at this point. We're just looking at price action. There's not a whole lot of news. We know oil is pushing up headline inflation. No surprises there. We expect core to actually drop. That's a big positive. Yeah, I think you got it successfully, Football Legends. Thanks for the support, guys. I appreciate it. So yeah, anyways, let's get through this. So what is the Fed saying? What are the Fed speakers actually talking about here? So as I keep the price action up. So this is Fed Barkin this morning. He said GDP remains solid and the labor market is remarkably resilient. Okay, that is good positive news. That's positive news. So when the market sells off on this positive news, and it's not just this, bonds are coming down, but the dollar's up. So the market is bracing for a surprise in the report. It's bracing for a downside surprise. My view is, if expectations are that CPI moves up 3 basis points, or 0.3%, or 0.3, right? Whatever you want to call it. If it moves up, if that's the expectation, that actually is a really good setup to beat that expectation. That's a really good setup to beat that expectation. Plus, if it does move forward, we know that it went up because of oil prices. Okay, it went up because of oil prices. And oil prices are not surging to all-time highs. They're just at the top of the range. They're at the top of the range. Unfortunately, that does slow down the macro. But if this is it, if it can't get above this range and it heads lower, which we talked about yesterday, then the expectations for the market to to find that bottom and to anticipate the Fed holding rates and cutting sooner than expected is going to be positive. If we cut rates, mortgage demand is going to start to surge. If we cut rates, all that money market fund cash is going to start flowing into the markets. If we cut rates, maybe this is 2024. Either way, the market's going to look forward to that. And you really can't throw out the fact that the White House is going to keep stimulating. You cannot throw that fact out. They've been doing it. They keep doing it. And that's just, It might be market psychology, but with the weakening economy, right? With things weakening, with the risk of student loan payment coming back, I expect Biden to keep, throwing out some stimulus there to help, spending from collapsing, right? The other part is the Fed's balance sheet. Are they going to step in? Are they going to start slow that balance sheet, or are they going to cut rates? What are they going to do first? Okay, what are they going to do first? So Fed barking again, inflation remains too high. Of course, they're going to keep saying inflation remains too high. We know that. That's not a surprise. That is not. We're looking for surprises in the language. Where's the shift happening in the language? Fed Harker. Okay, this is a different Fed member. Our forecast is not that inflation might spike back up. Okay, so they're not forecasting a spike in inflation. This could mean that the pause is on. Fed Harker, supply chain issues are starting to heal, though they are not perfect. That's a positive. If supply chain issues continue to heal, you're taking a large piece of the structural inflation off. Therefore, even if demand comes back, when you have strong supply chains, okay, and I'm looking 3 months out, this print's going to be hotter than usual, right? But if the supply chains continue to heal, then what you really get is, a lot of the supply side inflation start to um, be able to suck that demand in without pushing inflation higher. So the supply can support the demand without us really seeing inflation go up. That's what you really want. You want more productivity, and that's set to happen. We're not looking at supply chains falling apart. That would be a black swan if we got supply chains broke. If they broke, or if they fell apart, or something bad happened geopolitically, inflation's going higher because you take away the ability to supply people, and therefore prices go up. Fed Harker, fiscal stimulus is burning off. Okay, maybe he's saying that the fiscal stimulus isn't, I think he's talking about the old stimulus. I didn't hear what he said exactly, but we have new fiscal stimulus, and that's not coming off, right? Inflation Reduction Act, infrastructure bill, all this stuff is set to go through 2026. So the old stimulus, the old fiscal stimulus, the checks, right? The savings, whatever it is, that is burning off. That is true. But we have new stimulus coming into the market, and it's going to be selective. It doesn't just go into, it's more so for corporations, right? Infrastructure, that's going to go straight to corporations who are building like Caterpillar, chips, EVs. We're going to have a second run here. We will have a second run, but the market is anticipating inflation to bounce. We see the dollar up, we see oil up, and we've been citing these risks for a while. It doesn't mean the bull market is over. It does not mean the bull market is over. There's too many positive catalysts. It means that it needs to take a breather, that it will take a breather at this point. Fed Harker, we're going back to a more normal circumstance. Okay, we're going back. That's positive. I think a soft landing is quite possible. Okay, a lot of people might disagree with that, but if GDP is increasing, if the labor market stays tight, you're going to have a soft landing, right? You might have some breaks in certain parts of the economy, but you have expansions in other parts of the economy. So the soft landing is still here. Okay. Fed Harker, I'm skeptical that AI will cause any significant productivity boost. Well, he's not a technician. What do they know? What do they really know about AI? I think you have to listen to corporations and more, technical. You have to listen to the actual earnings reports to see how is AI, actually boosting productivity. So we'll leave that up to the earnings reports to continue to increase that productivity. So far, we've seen it because if AI is coming into the market and earnings are able to, rebound, not revenues are declining, but if earnings are rebounding, then, companies are able to manage their costs and retain that revenue. They're able to retain that revenue regardless of the revenue decline. That's very positive. What's going to happen when GDP starts pumping consumer spending and jobs stay strong? That's only going to increase revenues and margins even further. Fed barking, the workforce is still the number one issue for companies. Okay, I don't know how. We're still structurally short skilled workers. Okay, maybe that's true. I don't know what he means by that exactly. Skilled workers. We're short skilled workers. Well, maybe that's a headwind that we'll pay attention to, but it is what it is. Long dated, downside remaining popular. Okay, that means nothing. Fed market, there's still some time before the next meeting to see how the economy and inflation are behaving. Yes, you got a whole month. We have a whole month before the Fed actually comes out and makes another decision, which is going to be key because we're looking at business activity, we're looking at inflation pressures, and really they keep sticking on core. So, hey, core should continue to decelerate, right? That's what I'm saying. If core decelerates again, forget headline. We know headline's going to be stickier this month. If core drops 4.8, the expectation is 4.8%. If it drops at least to 4.6, 4.5, we could even see 4.3. That's going to be a huge divergence of expectations, and the market's going to feed into that. That's going to be very positive. I don't want to pre-declare, oh, this is Fed barking. I don't want to pre-declare where rates are going to. Yeah, you don't want to talk about it. We don't know. So they're still kind of neutral about where rates will be. There's still a competing outlook for the economy. One where inflation will glide down to 2%. Oh, wow. Okay. So he's citing that there's still an outlook where inflation does get to 2%. And that's where it remains persistent. That's really what this whole competition of, not competition, but this is really where this whole narrative is going, is how fast does the Fed get to 2%? How fast do they get there? Because as soon as you cut rates, liquidity rises significantly. All right, liquidity is down. That is the reason stocks can't make a new high off these good earnings. Liquidity is down, meaning the money market funds, they're not releasing liquidity into the market. The Fed's taking liquidity out of the market. The bond market, because the U.S. Treasury is taking liquidity out of the market or out of the banking sector. So we're low in liquidity, right? We need China to start pumping again. We need Japan to start pumping again. We need Brazil to start pumping again. But everything's on pause right now. So global liquidity isn't moving up this week, okay? But it's only a matter of time before it starts to turn up again, because those economies need to reaccelerate. China has no inflation, and that is the key. China has no inflation, which means they can turn that money printer on, and I expect them to do that. And we're going to keep track of that global liquidity measurement to see what China starts to do. All right. So New York Fed credit card balances rose. So I know credit card credit is up a lot. I know the debt went up. Like, people were citing that the credit card debt is at over $1 trillion now. But it's all about the interest payments, right? The servicing payments are really what matters. That is still a risk to the market. Auto loan balances also rising, right? A lot of defaults. That's also a risk to the economy, not necessarily the market, but to the economy. The reason I say that is because if defaults start to happen, if consumers stop spending, if retail sales go negative, the Fed's going to have reason to definitely pause and now start talking about cutting rates. That's going to significantly crash inflation, and it almost turns into good news, right? If things slow down, it's almost good news. And the reason I say that is because inflation evaporates, it disappears. Okay, if the economy weakens significantly, inflation does start to disappear. And then people will say, oh, well, the recession is going to increase. The chances are, it doesn't matter. It doesn't matter, because as soon as the Fed cuts rates in an environment, the market isn't looking at what the economy is now. It's saying, oh, you're going to cut rates, the economy will be stronger in the next 6 to 12 months, right? So at this point, inflation is still the dragon that needs to be slayed, and it's not over yet. We're going to get a bump. That oil price surging is basically the risk that we've been citing. It is the oil market, right? That is the biggest risk to the market. It's going to push up headline inflation. Core is going to keep decelerating, right? Shelter is going to keep coming down. Not the prices, not the housing prices. It's the rate of change of housing going up, because you measure it against the appreciation of capital. So if capital is up 5% and housing inflation is up 2%, well, your capital is appreciating faster than your costs. So that's why it's good. Now, if you get 5% inflation on housing, you have trouble there, but we are coming down. Delinquency is roughly flat overall, edged up for credit card debt. Okay, cool, great. There's still a lot of jobs out there, so I think people can service their debt for sure. Moody's says, so we got the downgrade from Fitch, but Moody's, another credit rating agency, says the banking system is still pretty strong, not broken. So the Moody's downgrade was nothing. It was a nothing burger. We already kind of knew what was going on there. They're kind of late on that. I think there's a path to economic soft landing. This is Fed Harker. The unemployment rate may tick up a little bit, but not a lot. And if it does, again, more reason for the Fed to pause. We don't want to overdo it with the Fed tightening. Okay, that's kind of dovish. We don't want to overdo it. We don't want to crash the economy. It's kind of positive. Sometime, probably next year, we'll start cutting rates. So sometime, maybe it's January, maybe it's February. We don't know exactly. What else do we got here? It is definitely weakening. Seatown Rocks 100. Not sure. Let me check the YouTube comments. I'm sorry, I have a totally different setup. I can't even tell. So I'm just going through some of what the Fed said. This is the only thing that really matters right now is what the Fed is going to do for inflation expectations. That's it. The technicals are trading on their own. There's no real economic data, right? We know the economy is recovering. At this point, it's not really a question if the economy is recovering. The question is, will inflation rise again? That is the question. Will inflation start to rise again? Well, oil is the big, proxy for that. Oil is the leading signal for that. And I don't think it can last because, yes, our economy is recovering, but it is not accelerating. Okay. Key difference there. We're recovering, right? We're not going down as fast as we were, but we're not accelerating. The economy is not accelerating. People are not spending exorbitantly, into the economy. They're spending enough. The expectation is better. So a mild growth, right, is exactly what we need for the market to hold on to the bull market trend. The bull market trend is still in place. We're not in a bear market trend just because we pulled back. Maybe we come back to 4,400. We're actually there. Maybe we come back to 4,300, 42. But the bull trend is still there. If anything, all this cash on the sideline, all these fund managers, $5 trillion in money market funds, they're going to start releasing some capital knowing, oh, the Fed's not falling apart. Fiscal policy is still on. The Fed's actually going to pause. This is the setup. The macro is turning, but you need the dollar to really roll over. And we're not getting the dollar rollover. That's going to be the signal for me. Okay, so yeah, we're looking at S&P here. And if we look at the dollar, DXY, right, this is the big macro signal. And it just hasn't rolled over. It actually moved. This is actually pushing liquidity down also. It's sucking liquidity. The dollar is sucking liquidity out of the market, right? Whether it's in bonds, whether it's in stocks, the dollar's sucking liquidity out. Because like I said, you're earning cash, you're earning yield on your cash. So the market is competing and the bond market is competing with cash right now. So what's going to get cash to start moving back into the stock market? It's going to be inflation expectations moving sharply lower, right? Sharply lower. We're not going to get that this month. It looks like we're not going to get that this month because of oil prices. But if oil rolls over, September is expected to be the most weak seasonal month. But again, if those expectations fall significantly, then and the Fed actually signals the pause in September, they signal, okay, we're going to pause here. And they're doing stuff that is unprecedented, right? They're pausing and then hiking again. They've never done that. This is the first time this has ever happened where they paused and then they hiked again. That doesn't happen. Usually they pause and cut or they hold the pause. So there's a lot of uncertainty. There's a lot of uncertainty. Other than that, we just got to watch market breadth. We got to see is market breadth advancing or declining? Are more stocks moving above their 50, 200, and 100 moving averages? If that's the case, then the market is choosing to roll that risk back into the market. A lot of equal weighted indexes are actually moving up versus the cap weighted indexes. That's good. That's healthy for the market. So we got to track whether we cap that up. Okay, 1 second. I'll go over those questions. All right, we're back. We're back. So yeah, we're just pulling back into support. It's really going to come down to CPI. That's the message here. That is the message here. Now, going over to, I'm going to move over to some of the, let's see, what were we looking at earlier? Bitcoin is actually moving up today. That's really interesting. You got to keep your eyes out for that too. I don't know if you're any crypto investors, but Bitcoin is catching a bid off this because people are really looking for a risk. They're looking away, they're looking for a reason to get in. And if that ETF goes, you're going to see Bitcoin start to outperform uh, Nasdaq and S&P by far, and small caps. Still a very small market. Plus, you have PayPal creating the stable coin, which is built on Ethereum. That is going to be a secular trend that continues. And if that's the case, you get a real bid into Ethereum to create more stable coins so that central bank institutions and commercial institutions, right? So Bank of America, Citibank, PayPal, whoever it is, they can now plug into DeFi with their stable coins, right? So they can access Web3 with Web2. If that's the case, that's going to be a new bull market. You get the ETF and you get stable coin creation. That's going to be a gigantic market. It is tough to understand why and how that happens because it is a whole new technology. But stable coins are kind of the bridge right now for DeFi. And Bitcoin's going to go much higher than that. There's a lot of demand for it already. All right, so there was a chart I wanted to look at. AI mentions on earnings call skyrocket this season. Yeah, of course, AI is here. It's it's definitely going to continue. Cleveland Fed CPI model predicts that the year-on-year CPI will rise to 3 point. So the Cleveland Fed's anticipating CPI to go to 3.4% and then 4.1% in September. That's going to be rough. That's going to be rough. That means oil prices will have to keep going up. So again, like I said, if oil gets above 83.50, the market's going to have a problem. It's going to have a problem because it's going to lift those expectations for headline. But core, on the other hand, I think it stays where it's at or it falls. I think it stays where it's at or it falls. So that's our risk right now. And the dollar is also signaling to us that the market has to stall at this point. All right, subcomponents contributing to GDP. Dang, no sleep, can't even think right now. GDP growth forecasts. All right, so most of the growth is coming from government spending. Sounds bad, but that's going to convert. That government spending will convert into consumer spending, right? I don't think it really changes. A lot of the other growth is coming from what is the second non-residential fixed income. We do have a lot of fixed income in this, dividend income, fixed income here. The fact that housing prices are still increasing slowly, maybe the property values fell in like Seattle, but the fixed income is still coming in. So wealthy individuals are still spending in the economy regardless. Other people are just choosing more cost-effective ways to fuel their spending. That's about it. But the GDP forecast for most GDP forecasts are increasing, and that should run into revenues for S&P, and I expect that to bid up. All right. So the technicals, some of the technicals of the market. What do we got going on here? I know a lot of stocks are pulling back. Wasn't the first time actually. Max Power, it is definitely weakening. What is definitely weakening? It is definitely weakening. Not the first time. I know I'm answering that from a long time ago. All right, so yeah, let's go through some of these. Now, let's jump over to our favorite, Tesla. What's going on with Tesla? All right, what's going on with Tesla? Let's do some technicals here. Tesla came all the way back down. Like I said, if the market rolls over, Tesla will go back and test the next support. And Tesla right now is testing 240. Okay, these sharp downturns, though, usually result in a sharp upside move. We need the market to bounce. I think personally, the market is selling off into the CPI report. Because if it comes in as expected, then the market's not going to be surprised. They're going to say, okay, it is a little higher. We're not surprised. We sold off ahead of time. Now, what are some reasons to get long? What are some reasons investors can start deploying some of that cash? GDP forecast, right? The other macroeconomic news that's coming in. So you have other news that'll come in after CPI, which I think you're not really going to get the market decide what it wants to do till Monday, not Friday, but Monday. It has to digest the news over the weekend. That's why I like Mondays, because I feel like Mondays have digested all the news. It takes a couple days with no market action to digest it, and then Monday comes in. And what did I say last week? What did we talk about last week? All this information that came in from the previous week, the market has to digest it, and we'll decide if we go lower. And it took in all the earnings reports and said, okay, nope, we're going lower, right? Apple's revenues still weak. Even though growth might be bottoming, GDP's up, still weak. Let's sell off into the inflation report. We're up a lot at this point. So for Tesla, they need a new catalyst, right? The Elon catalyst that he has to get back surgery, neck surgery. The dude has a messed up spine. He's probably been sitting there. A lot of people get neck surgery. It's not like he has like internal disease or cancer or anything. That would be something to worry about because he might not be the CEO. But this is just, he wants to fight Mark Zuckerberg. Who knows if that's really going to happen? And he needs to have a strong neck, right? He needs to get fixed so he doesn't have a lot of pain. I can associate with that. Sitting in a chair really hurts your body a lot for too long. So yeah, he might get surgery. That's not a good reason to be bearish on Tesla. Either way, major support now for Tesla, 241, right? 240, 240, 241. And we had a nice reverse. Is this the daily chart? We had a very nice bullish reversal yesterday. Reversal candle, very strong bull doji, bull hammer doji. I just call it a doji, bull hammer doji here on the daily chart for Tesla. That's a reversal candle. Okay, yeah, we gapped down a little bit because the market is weak, but I think there's a lot of buyers down here for Tesla. If it does fail, it's gonna close. If it does roll over again, which is very possible, right? It depends on how the CPI report comes in. If inflation comes in at 3.4, the market's gonna get crushed. It'll get crushed if CPI comes in at 3.4. If core inflation ticks up, the market's going to get crushed. We're going to have to go back and find the next support. But if we happen to come in as expected, then we just consolidate sideways for a while. There's a lot of support there. If it comes in below expectations, let's say 2.9, the market's going to digest that very positive and bid higher. It's going to say, wow, even though oil went up, we're still moving up. We're still moving up, or we're still, inflation is still falling. So again, like I said, not too worried about that. It's really if we get above 3.4%, which some people are expecting 3.4. That'd be a big move up. That'd be the first move in this entire inflation cycle that inflation bumped up month to month on the headline. That'd be the first time. Okay, so that is some, and then you got to see how the dollar reacts to that. Anyways. The next is 235 is the gap to fill. 234.85, whatever, 235 on Tesla. I think that's the lowest that price really gets, in my view. I think the stock is just way too strong to drop below that. So 235, I think, is the bottom. I know people think it goes lower, but I think 235 is that gap to fill because China is going to start stimulating again. That's going to increase demand in China. That's going to increase spending in China. And same thing for Japan. They're going to start spending again. The global economies are starting to loosen up. And China is one of those multinationals that benefits from those global economies strengthening. So that's my view on that. I know Palantir pulled back big, right? Palantir got above its skis, though. It got above its skis. It's still a great play, but it moved up so quick over the past, 4 or 5 months. It moved up very quickly. It almost tripled. It basically almost tripled. So it was going to be really tough for the stock to keep going up when the market is weak, and it already bid it up so much. But hey, the big news for Palantir, if they continue to beat earnings, now they've been positive for 2, or has it been 3 months? They've been positive for 3 months. I thought it was about 2 months. Maybe it's been 3 months. They've been positive for a while. So S&P inclusion is on the table for Palantir. If they beat earnings again, I think in Q3 or Q4, then not beat earnings. I'm sorry. If they're positive, the positive net income, then Palantir should now be considered to go in the S&P. And if that's the case, that's going to be a big catalyst, right? Now that's outside of the macro. We're just talking technically, looking at these stocks. Apple's the big mover. Where does Apple bottom? I think this is a bellwether for the stock market. Apple's oversold. On the daily chart, Apple is oversold. It hasn't been this oversold since October. December. Last time it was this oversold this was December, basically going into the new year. That's the last time we've seen Apple oversold. And that was the bottom. That was the bottom. So, Apple ain't going nowhere. Apple has a better credit rating in the US, so they ain't going nowhere. Um, and this might mark the bottom, so still stay optimistic about things. China, they start stimulating, that's going to accelerate Apple, right? Is if they start stimulating fiscal monetary stimulus, that's going to be that's actually probably a better bid for Apple than possibly Tesla, just because iPhones are so everybody has iPhones, right? Everybody has iPhones, so they might be upgrading on their new iPhones or whatever. So expect those revenues to increase. I think China is just a big deal. China's a big deal. They are weak right now. They have been recovering. That recovery stalled, and we see global liquidity also stall. But on a technical basis, Apple has bottomed on the RSI. Could it go lower? Sure, but you have to have really bad news for this to go much lower. It already sold off. I mean, how many billions of dollars is that? If it was at like 3 trillion, then we're talking, man, we're talking $300 billion deployed out of Apple. Nearly 300 billion. That's a big move. Anyways, it's oversold on the RSI. Maybe it trickles down here for a while, but I think it's at support, right? The previous high was for Apple. Let's see, what was the previous high for Apple actually? Not the all time high, not the previous all time high, but Janet Yellen over there going to other countries. I'm listening to Janet Yellen. Bro, I'm telling you, they're trying to speak with China to make a deal. They need the dollar lower. I think that is the case. Global economies need the dollar to slow down to recover. The dollar is 80% of global debt. So the higher it is, the higher your debts become. Transactions, it's still, regardless of BRICS, it's still, 75, 80% of global transactions. So you need the dollar lower. And I think that's what Janet Yellen is trying to do. They're trying to do some type of yield curve control. And maybe it takes a couple months, but I think that's what we're going to see. So Apple, I see 175 is about that next support. The next major support, maybe 175 for Apple. Those were the tops previously, on the chart. Those were the tops. It's about time it pulled back. This is healthy, right? This is healthy. You want these big names to pull back significantly and give opportunity to all that cash that just hasn't came in. So I think this is positive for the market to see some of this pullback. It's going to come down to the macro aligning with the fundamentals. So the fundamentals, let's go over it. What is the macro fundamental and technical outlook? Technicals, the market's in a bull market. It's going higher. Fundamentally, revenues are weak, but earnings are starting to bottom out, right? The earnings picture is better than expected and bottoming out for the S&P 500 in general, right? The macro inflation is coming down. Forget this noise, right? This is noise, bro. I am telling you, this is noise. Oil at 83.50 is small noise. It's not going to keep up because other producers, Venezuela, Iran, Iraq, they're still unloading supply into the market. So I just don't think, I think traders are getting long oil. It's a great trade. And hey, if it gets over 83.50, then, we're wrong. If it gets over 83.50, I'm putting that rate hike on the table for sure for September. For me, anyways, that's going to cause for further weakness and hold above 83.50. But anyways, yeah, that's the macro outlook. Inflation is coming down. GDP is turning up. Consumers are still strong. They still have jobs. Joe Biden's still stimulating. So nothing really changed here. The market needs to take a rest. Back into support 175 for Apple. I think Microsoft has actually been moving up. This is another big mover. Right now, this isn't market breadth. These are the mega caps, right? This is definitely the mega caps. I'm going to load that macro chart here. So we are looking at the mega caps here first because they are taking a rest. But it looks like Microsoft is just pulling into the previous support also. I like this setup. Amazon. Amazon's lagged lately, so Amazon might have some room. It's not falling apart. It hasn't even filled that gap to the downside. So Amazon still pretty looks pretty solid. You get support by the 50-day EMA also on the daily chart for Amazon. Google. Google might pull back a little bit. Still looks pretty solid though. Meta, no trend breaks, right? Everything's still pointing higher. Meta just trending higher consistently. Nvidia is coming out with that new chip, another chip from Nvidia, monster chip. It's supposed to create, it's not just I mean, I'm not a technician, but they basically have a new chip. That's not going to play. We need inflation to 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 roll over right before this news really starts to come in. Hey, S&P is looking good right now. S&P is above VWAP. I think this is literally just a technical pullback, tactical selling and tactical buying. Nothing too treacherous. We're not seeing a treacherous, sell off at all. Calm down, right? No treacherous sell off. It's great that we're selling off into the inflation report. Google, Meta, now IWM, small caps pulling back. What does SoFi look like? I know there's a lot of disturbing. SoFi just pulling back pretty sharply, right into that 50-day moving average. Square, Rivian earnings. Any insight onto Rivian earnings? Let's see, Rivian earnings. Not really. I wouldn't be surprised right now. The overall market is, I think a lot of stocks bid up into earnings. So I would say for Rivian, forget their earnings. If they beat earnings, they could just sell off. Like at this point, the whole market pretty much bid up into earnings, um, anticipating that earnings were bottoming. So I don't think there's going to be any big moves. That's the feeling right now. S&P is bottoming, and it's not selling out. It's consolidating. So I wouldn't expect any big moves until the macro improves again. The macro got us here. The macro improving got us here, but now the macro needs to take a breather, as in inflation is now being influenced higher by oil prices, right? So unless that core drops significantly from shelter, I don't expect any earnings reports to do anything. I know people say, "Oh, well, you have to have a really big beat in earnings and a real secular story to really just break out and defy all odds in the market." Interest rates. When I say interest rates, I'm going to talk about the Fed funds rate. The bond market is elevated right now. That's the other issue. It hasn't came down, and that tightens financial conditions. So the only way that those loosen up is if inflation comes down, because the bond trade is a really nice setup. Don't get me wrong, the bond trade is a really nice setup. You're going to get fixed income. I think TLT is paying 4.2% currently right now. That yield changes, right? 30-day payments on TLT. So it's paying you every 30 days, not 4%. You got to annualize that. But that's a lot of good fixed income. The bond market is at the lows. And if you think the Fed's going to cut next year and start re-stimulating the market, then bonds over the next 12 months is a really good trade. The problem with bonds is that you need inflation to significantly, you need that core inflation rate to significantly get below what the bond is paying. If bonds are paying 4% and core is at 4.8, well, you're not really getting much, you're not getting any yield. You're still a negative yield, right? And you could debate how it's calculated, whatever, but what you want is you want the inflation core, because the headline's down. You want core inflation to be around 3.5%, and then your bonds at 4%. And now you're yielding 0.5%, right? And you still have the underlying asset to go higher. So you just want positive yield against inflation. And that's what we're looking at. Some growth stocks, they don't care because they're not yielding you anything. They're just going to grow. But if you're talking about fixed income, fixed income is another part of the market internals that you want to pick up to support the market, right? A lot of the baby boomers have a lot of fixed income, and they're not really looking for growth stocks. So if you get fixed income, you get some optimism in fixed income, then rates come down again. So again, it always comes down to inflation. That's what I'm saying. We just got to focus on, the trajectory of inflation, and the two signals are oil prices and the dollar. Pretty simple. So I'm sorry. I know it wasn't about Rivian. I don't have insight on Rivian. I really don't. I think it might be overhyped. I know a couple analysts are citing that Rivian's growth. They're putting a buy target on Rivian versus Tesla. Bank downgrade triggers stock sell off. Treasuries dollar rally. What is this? What is this crap, man? Yeah, I don't think the earnings matter right now. That's what I'm saying. I don't think earnings matter. The stock market bid up into earnings. So if anything, all you want to hear on Rivian is how are their margins and what is their guidance? Where are they expanding to, right? The actual beat in EPS isn't going to matter. The actual beat on revenue isn't going to matter. It's going to be, what is your guidance in Q3? What is your Q3 guidance? What is your Q4 guidance? What is, what are your margins looking like? Do you have to cut costs further to hurt your margins? That's what I would think. PM916, I appreciate it, man. Thanks for listening in. But yeah, that's what I think about earnings, and it kind of showed with Tesla, right? Tesla beat top bottom line, a lot of good news. It sold off. It ran up into earnings and sold off. The overall market is running up into earnings and selling off. So earnings are not the focus right now. The market is concerned with this bond market bullcrap, where the U.S. Treasury is basically selling. They're creating new debt, so they're debasing the bond market. That's why bonds are selling off. They're debasing the bond market, and then they're pushing more bonds into the market, which higher yields. So we need a bond buyer. Japan was usually that buyer of bonds to lower our rates, but Japan is having issues, so they have to stop buying our yields, our bonds, and they have to start buying their own bonds. They have to do yield curve control, where they buy more of their bonds to pull down the rates. That's when bonds go up, rates come down. Simple as that. So they're not the buyer right now in our market. And what we want is the U.S. Treasury to be a buyer. Maybe Janet Yellen's over in China making a deal with the finance ministry in China, saying, "Hey, invest in our equities again, please." We don't want, they don't want to do that. People are heavily tied to the BRICS narrative, where the dollar is going to get crushed. But Janet Yellen, if she makes a deal with the Chinese finance ministry where they start buying some of our equities and we offer them something, that's going to bring down our yields, right? If the Fed does, well, the Fed said they're not going to buy any bonds anytime soon. They're unloading bonds, so we need somebody else to buy them. But the bonds are pretty juicy here. I mean, you're yielding 5% on a 2-year, 4.5%, whatever. This is the juiciest U.S. bonds have ever been. So at some point, bro, when inflation collapses, which it has been falling pretty quick, but now we got oil up, there's going to be a real rush back into bonds. There's going to be a rush into stocks. And the bull market, the FOMO will continue. Just right now, we got to stall. We stalled out, right? Why do we have so much recency bias? Just because we're stalling out doesn't mean everything's going to roll over. It just means, all right, let's get with reality here. We still have risks on the table. Okay, we still have risks on the table. And we got to leave that to the fiscal and monetary officials to see what they're going to do here. And I wouldn't doubt if somehow the U.S. starts buying back their bonds. They said they were going to do that. So are you going to bet on that? No, you don't want to bet on that. You don't want to bet, okay, when are they going to do it? We don't know. But the macro picture is improving still. That's what I would say. What up, Prakesh Podley? Do you think it will bull with this gas price, bro? It will it range? Gas prices. I'll say this: gas prices are an input, not an input, but gas prices are going to fluctuate with oil prices, right? Gas prices will fluctuate with oil prices, and right now oil prices surged 17-18%. I think gas is going up. I haven't really looked at gas. I'd have to go to the macro gasoline. Watch, let me look at U.S. gasoline, because U.S. gasoline is a little different than other areas. In the region of the U.S., gasoline prices are different everywhere you go. So it's not like a clear picture. It's mostly the macro. Is it moving higher or lower, or does it move sideways? It all depends on that oil price. That is the most important chart for this whole last year, is the price of oil. That's what I've been saying. So let's see how gasoline prices have responded. I'm going to look that up really quick. U.S. gasoline. There you go. U.S. gasoline prices. They're pretty muted. So what I'm reading right here is basically the U.S. This is U.S. gas prices, liter, whatever. I don't even know what it is. I'm just looking at the damn charts. Okay, they stalled in April. We're at the same degree we are from April. So April, May, June, July are all at 0.95. Right. They marched from December all the way through. So we're at a 6-month high in gas prices. We're at a 6-month high, and this might be for producers. I'm not sure, but we're at a 6-month high. But we're even here. We're not moving higher. But if we look at the bigger trend here, Um, gas prices got up to, and I really don't know these units. It's like 1.2 maybe liters per something, whatever. I'm sure this is for the supply chains or for the gas, not really prices for people. But I like to look at the macro data. I want to see the producer prices of gas, not the consumer prices, because those are going to lead. Producer prices always lead consumer prices, right? So we're kind of flat. It's not really moving up. I would say if I had to make a guess, gas prices still move up a little bit, and they just trend sideways. They move up a little bit. If oil breaks out and gets above 83.50 and really starts to move, gas prices are going to start shooting up again. So we're tracking oil prices as the input to where gas will be in the next month or two. Okay. And it's at oil's at a 17% high. It's at a 17%, not a 17% high. It's up 17% month over month. All right. So, but we're stalling out right now in August. We're kind of stalled. We're kind of stalled. So that's what I'd say. Um, hey, the oil trade might be in too. Like a lot of people might trade oil higher because they see it. I personally think that too many people are betting on OPEC continuing to cut production. So I think I lean on the side that oil cannot last up at this level. That's where I lean. I think the demographics are weakening. I think the demand for oil is still weakening. And I think it's more sensitive. I think the pain trade is actually higher right now for most people as far as the macro. But I really doubt that over the next 3 to 4 months, that oil can just stay higher. I really doubt that. Based on my research, based on what I've seen, that's my view on it. Now, can it go higher in the next month? Sure. But manufacturing is suppressed. Okay, a lot of people are spending less on travel. The summer time is over. So the catalyst for oil to go higher is all on trade. It's all the trade. It's not really, there's not a whole lot of macro support unless you believe that OPEC keeps cutting production, right? Or whoever is in OPEC keeps cutting production. But you have other countries, Venezuela, Iran, Iraq, Brazil. You have other countries, plus the US, who are increasing their supply. So at some point, those are going to balance out, and then oil can't move much higher. So I'm watching the 83.50 level. Listen, this has been the biggest level technically. This is where I'm wrong, right? 83.50 is the biggest level. This has been a level to that's been resisted since December. So over the last 6 months, this is where oil gets stuck, 83.50. That's why I'm keeping my eye on 83.50. Oops, I had a Rivian up there on the thing. So yeah, 83.50, this is the zone. And after that, probably 95, 93, 94, probably 94, 95, somewhere around that zone. What up, William? Any YouTube questions? Let me see. No, I don't see any YouTube questions. Hey, if you guys don't mind, jump on the YouTube, subscribe, help me with the algorithm on there. Again, that's where I have the charts on there. I'd appreciate it if you guys could. All right. Let's see. If S&P bull, it's straight up manipulated. Joe trying to make it look like economy is recovering. Hey, I get it. I get it. But, and trust me, I have family members who say this because it's all political. It doesn't matter what you think. The economy is recovering. So forget Joe. First of all, we know Joe is just a puppet. So Joe's a puppet, right? So if you take his name out, maybe you'll be more open to understanding the economy is recovering. GDP is up. The manufacturing cycle, new orders for manufacturing are bottoming out. The unemployment rate is low. So this economy is recovering, okay? It is, or it's bottoming. It is bottoming. It's not plunging lower. And the reason why, Prakash, is because the infrastructure bill, right? The infrastructure bill is 1.4 trillion dollars. Like that's real money coming into the market. Caterpillar's up. So you can't deny the fiscal stimulus coming into the market. Like you can't say that's fake. That is supporting this. And of course he's going to keep stimulating for his election. He's going to keep doing it. He better just hope that inflation doesn't reignite while he does it, which is why he's not buying oil. He's not filling the SPR. Because if he does, then you put a bid on oil. Oil brings up inflation again. So he's trying not to buy oil right now. have to would you say Joe has to fake and manipulate the market to give some votes from liberals? Well, he can't manipulate the market. He cannot manipulate the market. All he can do is influence people. You're right. He's going to influence voters to vote for him by trying to do student relief programs and stimulus. Hey, presidents always do this. This is how you get votes, right? Take your emotions out of it. This is how you get votes. You strengthen the economy. You promise people jobs. That's not really manipulation. That's what they do, right? Manipulations is what the banks do. They come out with research that says one thing and they do the opposite. But he can't manipulate the market. It is a free market. A president can't do that. What they can do is manipulate. What they can do is push bills that are going to spend money. That's all they can do. That's not really manipulating because everybody can see it. We can all see the bill. We can all read the bill. We can all see where the money's going. So that's not really manipulation. He's just trying to keep the economy from falling apart because it increases the chances of not having a bad rating or whatever. But either way, right, anybody would do this. It didn't matter who you are. You're always going to try to stimulate more. The real issue is inflation. Can he do this without inflation ticking higher? And I actually think it can happen because the more jobs you get, the key to fiscal stimulus, the key to government spending is to get people back into work, into jobs, skilled workers, so that they can produce more. The more you produce, the more you grow GDP without increasing inflation, right? But if you just have a bunch of people spending with no supply, or you have a bunch of people showing up at a restaurant to eat, but there's no workers there, well, you're going to have to increase the prices because you can't start. Well, I don't know if that makes sense exactly, but basically, if I would say the lemonade stand, the more, the more production you can do at the lemonade stand, the more you can produce, the more lemonade you can create, the lower your prices you can do, right? To meet your quota. But if you have no lemonade to meet your quota, you have less lemonade, you're going to have to hike the prices to meet your quota. And that's the real issue in the labor market. For the government, for the Fed can't really do anything about that. They really can't. So this is all fiscal policies. If they can somehow get jobs up, get people coming in to work into the right jobs, incentivize people to work more, to produce more, then you can keep spending on track, and then you actually reduce the inflation, the supply side inflation. That's good, right? That's positive. So get his name off of it. We know he doesn't even know what's going on. We know Joe has no clue what's going on. So forget him, right? It's really the powers that be trying to keep them the economy afloat. That's sort of what it is. But anybody would do it. They would stimulate fiscal stimulus. And what we do as an investors is, hey, we try to take advantage of what the Fed and the government are trying to do. That's all we can do. We can't change the rules of the game. People want no inflation. Well, guess what? That's how growth goes up. You have to have inflation for growth to actually accelerate. Okay. Without inflation, you have no growth. That's just how the system works. Can you enlighten Tesla's financial situation? Well, there's a lot to Tesla's financial situation. They have a lot of debt. They have a lot. They have a lot of cash flow. They have low debt. They have the best. I'll just say this: they have the highest revenue growth out of all the other electric vehicle companies. So their revenue growth is increasing. They're trying to create. They also have more revenue per. Not revenue. They don't have as much revenue as Ford and GM, top line revenue, because more people are still buying, Ford F-150s and other cars, so they don't have revenue. But revenue growth, their growth rate of their revenue is significantly higher than the rest of those, okay? They also have significantly less debt. They also have way more cash flow, free cash flow per debt, or whatever you want to call it, right? So Tesla has a great financial situation. It's just the projects they're doing are very risky because they've never been done. So they're an innovation company, right? Their energy storage business is growing. They're the best selling car in America. So financially, there's a lot of metrics to look at, but just to make it simple, here's the biggest hit on Tesla right now. Their margins are down a lot. They had 27% margins, so how much they could retain the revenue. Now it's at like 18, 19. And, Wall Street wants to see those margins climb back up. But what they're saying is, well, if we increase margins, then we're going to lose volumes. right? Because people can't afford the Tesla car. So they're trying to make it more affordable to increase the volumes or increase the demand for EVs, for Tesla cars. And then they can increase margins once rates come down. Because the real issue is because rates are elevated, most people don't outright buy an EV vehicle. They borrow money. Most people borrow money for a house, for a car. They're borrowing money and they're paying a higher interest rate. So he's trying to lower the prices so that people could keep buying because it's going to be too expensive. So I think it's a good move for the long term. For the short term, it might not be great for the stock, but for the long term, that's what you do. You sacrifice margins in order to get people to buy your product. You want a network effect. You want people to buy more. You want them to get addicted to the brand. And then you can increase prices or margins when interest rates come down. Because when interest rates come down, Tesla pays less interest. So do the customers. So it's a market share game they're playing right now. But financially, best revenue growth, very low debt. There's so many good things about what Tesla's doing, but they're also taking very big risks. The biggest catalyst this year will be what other OEM, what other car company is actually trying to license their full self-driving, right? That's the biggest catalyst. Who's going to license their full self-driving? He said maybe Musk is bullcrapping us, but he says, hey, somebody's interested. So when they release that news, I expect the stock to surge, especially because it's down right now. JD, manipulate according to stay hard. Big man's coming. U.S. China strong. Let's go. Yeah, U.S. China strong. And I know people say, oh, China needs to go down. You want China to be strong. Okay. The economies are much more complicated than that. You want strong Chinese growth. You just want the U.S. to out innovate them. We can't let them out innovate us. But all the global economies are connected. You can't just collapse an economy, and expect this to happen. Like it's really silly. What do you think about future trading? What is the best way to learn how to do it? That's a really, I'll tell you this, trading is very hard. Probably 95% of people fail and will fail over time. Trading is tough. I think day trading is really hard, and swing trading is a little easier. Position trading, which is holding a position over 6 months, 12 months, is the easiest deal if you do it right. That's the simplest way because you don't have to be quick on your feet. You don't have to know all this stuff. So what's the easiest way to learn? I'll just tell you this. The best trading, day trading, SMB Capital, okay? SMB Capital. They have a lot of good information, but those are pros. It's really complicated, right? Swing trading, you can probably look up swing trading channels. You can look at some of my content if you want. I have a lot of content. I'm going to get back into swing trading once this macro recovers. Right now, we're looking at some swing trades currently. I don't mind going over technicals also putting that in the stream so that we can show you guys how I would swing trade. And Charles King, who's a dude meeting with England, and doing some swing trading. But I would say this. You just have to keep searching because there's so many different trading is like what's your favorite food? There's so many foods out there. You got to find out what's your favorite food when it comes to a diet. What could you eat consistently? Right? It's not for everybody. Do you like fish? Do you like chicken? Do you like beef? Do you want to be vegan? Do you want to, right? Do you like carbs? Do you like fast? Do you like this? So there's so many ways to do it, and you really have to experiment with trading, and you're taking a risk no matter what. You are taking a risk. But I would say check out my free content on the website. Go to the website, link in the bio. Check out trading, read it, see if it makes sense. If you have questions, you come on the live and ask questions, and I'll answer them. After Thursday CPI report, we can take a long on S&P, QQQ, NASDAQ, UV, NAVA, Prakash. I agree, Prakash. I think we're just pulling back into support here, and I think the S&P is just pulling back into support, and we should grind. Because I don't think the CPI report is going to be that bad. I think people are anticipating such negativity on the CPI report. I like that. I want to see anticipation of negativity because I don't think it's going to be as bad as expected, right? And we got the opposite move recently, which is everybody's expecting such great earnings. Not great earnings. Everybody was expecting such bad price action, and the price action surprised to the upside. And then when earnings came out, they were good, but there was no longer a surprise. It was like, oh, okay, yeah, this makes sense. And then the market sold off a little bit. But we're just pulling back into support. I'm not too worried about anything here. And really, it's, hey, what is CPI going to look like tomorrow? Let's go over some of this data we're going to be seeing tomorrow. Make sure I didn't miss any stories. There's a lot of stuff going on. The biggest risks are the U.S. Treasury pulling liquidity out of the market through the bond market. So we got to keep track of yields, bond yields. The US dollar is literally the easiest signal. The higher it goes, the weaker markets become, right? The lower it goes, the more strength markets become. That's literally your easiest gauge onto the market to kind of feel where's all the sentiment headed to. It's the US dollar. And the most immediate risk is oil. So the higher oil goes, the more stress, future stress on the market because energy prices. The lower oil goes, the more optimistic I am. And it becomes exponential. It's not like one up, one down. It's like the higher oil goes, the more risks really come into the market. The lower it goes, the more likely CPI collapses. So let's see. Tomorrow we have Japanese PPI, and if it's low enough, they can keep stimulating M2 growth by India. Oh yeah, the Indian economy is also surging. India is very strong. So we want global strength. We want this global economy to recover. Forget your politics. We want the global economy to recover. If you're trying to make money or trying to learn how the markets work, you got to remove your politics and you have to just look at the data, look at the trends, and look at the technicals, right? Understand some of the fundamentals. Forget the politics. That never helps you out. You could be fooled by that. Everybody said that this economy would be trash and it would fall apart. But the fact of the matter is, hey, when you print $1 trillion into the economy, it's going to recover, right? It doesn't matter what you like or don't like about the guy. You push that much money into the economy, it's going to recover, right? The hope is it doesn't actually push inflation much higher, right? Which right now, oil is very strong. That hammer candle I'm seeing right now looks like it's going to push above 83.50. And so we'll see how things go. I don't know. I really don't know. I don't like this. VIX is going up a little bit. Move index is kind of stuck there, but it's really all about CPI. Where does the market find support after CPI? That's what I'm looking for on Thursday. Not day trading here, right? Not looking at any of that. The Fed is very optimistic. We also see the Fed optimistic. There's a lot of cash on the sideline. Let me go through some of my charts. The market is expanding. The market is expanding as far as breadth, so that's positive. Actually, let's see how many stocks are moving above their moving averages really quick. Okay, so 50-day, how many stocks are, oh, this is bad. Market breadth is coming down, advanced decline. Only 58% of S&P companies are above their, so they're dropping below their 50-day moving averages. They're starting to drop. We peaked at 90%. Now we're at 50%. So a lot of stocks in the intermediate over the last 2 weeks have really fallen fast. If we look over the last 100 days, right, we have, I'm sorry, the 100 moving average, 65% of stocks. So a little better market breadth the last 100 days. And then the 200, we're at 61, which means only 61% of stocks are still above their 200. The point is more stocks are above their moving averages than they are below it, but we're at risk of falling below that 50%. So if we get below 50%, market breadth is deteriorating. We don't want to see that, right? Just as a warning, we definitely don't want to see that. And that's pretty much advanced decline is, oh, it's recovering today. So that's pretty much what we're looking at here, right? We're looking for the market to find support. That's all we can do at this point. Looking for that support. See, can you show the charts? Rick Sanchez, charts are on Bluetooth, link in the bio. It'll take you right to the YouTube. That's where the charts are at. That's where I show all the charts, all the data. I'm gonna look on CNBC. Just look, is there any new stories? And then we're gonna get out of here. I'm just gonna see, is there anything I missed? There's constantly new stuff coming out, and I just want to make sure we cover all of it, or as much as we can while we're on the stream. I mean, obviously I can't stream all day, and my back will be broken sitting here. Let's see. Ooh, CNBC. Where's my? Hey, the positive news. If you're a crypto guy, that PayPal, that is a big deal. PayPal creating a stable coin is huge. New data shows Tesla could have a chip problem. Okay, let's read some of these. What is this? SPY? This is S&P. Okay, yeah, it's just S&P falling into support. I'm gonna keep the S&P up there and read this really quick. New data shows Tesla could have a China problem. Bank of America. Here we go. All the negative news. This is for Tesla. Tesla may be losing consumer demand battle in China. According to Bank of America, the electric vehicle maker experienced several months of strong demand in China after it lowered prices in the Model 3 and Model Y last December. However, the brand saw deliveries in China tumble 31% month over month in July, suggesting that the initial uptick was temporary, according to analyst John Murphy. with 31% month on month drop Tesla. Well, China liquidity also slowed down. Literally directly aligns with liquidity. Tesla's July deliveries absolutely were below year to date average of 80K. Blah blah blah. Meanwhile, BYD, which is Tesla's largest EV competitor in China, showed its sixth straight month of positive month on month growth in July, increasing by 4%. So BYD is outselling China on a month over month basis. Okay. This seems to indicate that the drop in demand for Tesla vehicles was not driven by broader economic factors in China. The analyst reiterated his neutral rating on shares. He maintained his price target of 300, which implies a 19% upside. Dang, he's still bullish. That's crazy. He's still bullish on the stock. The price cuts have created a negative spiral, according to the analyst forecast. He forecasts that the downturn continue. In the month over month data, that is not the macro trend. That's just telling you, okay, there's a battle here for market share for sure. Tesla's not completely dominating in these months, but I rather look at the year on year data to see the longer trend. Month on month just gives you insight on immediate risks, immediately what you're going to see maybe the next quarter. 2025 auto automakers followed Tesla's lead and announced their own price cuts or incentives, including BYD and XPeng. Okay. So BYD is outselling them on a month over month basis in China. As such, while the price cuts helped Tesla's clearing out inventory at the end of 2022, spurred demand in China, blah, blah, blah. Okay, great. So there might be, and funny, the headline is new data shows that Tesla could have a Chinese problem, could have a China problem, right? High rates, guarantee assets. Morgan Stanley sees 20% upside in this little known educational stock. Don't care. Any macro stuff. And that just came out. FTX, Sam Bankman-Fried still faces campaign finance charges. Great. Oh, you know what? That was interesting. So some people are trying to attach the Bitcoin rise to the Moody's downgrade, because it's like if you downgrade US, you better go into the Bitcoin, Bitcoin safe haven. I don't even know if I believe that Bitcoin's a full safe haven asset at this point. I don't know if I fully believe that. I think it's the ETF that's going to drive things. Maybe I'm wrong, but I'm still a Bitcoin bull. Don't get me wrong. I just think there's so many narratives, and over the past 3 years, those narratives have changed, and they weren't what people expected. So you just got to be open-minded about where you're wrong about the narrative and sentiment of things. Okay, credit card balances jump. We already know that. I think we covered everything. This is a boring week. It's really, I'm looking at the technicals here. I'm looking at the technicals because there's not a whole lot of big data other than Thursday. I do expect the market to sell off into at 4,400 S&P to sell off into. You see this zone right here on YouTube. That's where I'm expecting the market to sell off into. Going into CPI, 442 may be the low. If CPI comes out worse than expected, boom, we could trade down to 431 over the next pending weeks, because that would include the Fed hiking again, and that would include more interest rate risks. They would pile onto each other. But I don't think that's the biggest probability. I think it just comes in line. If we get inflation coming at 2.9 or even 3, the reason I say 2.9 is because we already had 3%, right? That's going to be big upside. The market definitely digests that and goes higher. But the probability it comes in at about 3.1, 3 to 3.1, I think that's more of the biggest probability. And the market just finds support, looks for some other data to trade off of. And what could that other data do? What could that other data be? What is the other data coming in next month that could change this expectation? Oh, plus core, right? If core comes in lower, I think that's going to be very positive too. So we got core. Oh, we have a lot of Fed speak. So we have Fed speak. That's going to make a big difference there. Also, PPI on Friday, right? Producer prices coming in on Friday. That's why I think we're not going to really see how the market reacts to inflation till Monday, because you got to digest CPI, core CPI, and then PPI, and then core PPI. You got to digest all of that. Hey, I will be here on Thursday. My brother, I believe, is having a baby, so I don't know how it's gonna play out. But if she goes into labor, then I'll just adjust my. We'll talk about inflation at some point. We'll go over these inflation numbers. There's usually a lot of good things to look at going into that. And then let's see, next week, what do we have next week for US consumer inflation expectations? On Monday, more export prices, manufacturing index. Yeah, I think it's going to come down inflation. All right. Well, that's it for me. That's it for me today. Thanks, guys, for joining. Again, take a look at S&P technicals because there's not a whole lot of data. Core inflation, I expect to cool off. I think that's the big change there. We're going to get core inflation cool off. And watch those oil prices. Watch those oil prices overnight, right? 83.50 is the big level. If it breaks out, watch for the dollar to rise and really start to hurt the market. That's what I'm looking at. I'm out. Appreciate you guys. Stay blessed. Get your exercise and keep a growth mindset. Catch you later.